I think to a large extent, even the diversification issues of investors investing in bonds are now sorted out because platforms like INR bonds are offering bonds now with the private placement even at coming in at 1 lakh face value, and a lot more public debt issues coming in with rupees 1,000 face value. Now, technically, an investor can buy, say, a 5 to 6 year bonds of any rating, say a AAA if they want a AAA portfolio, or a AA plus, AAA to AA plus, or a AA to A portfolio, or A to in a portfolio of higher yield portfolio of A rated bonds where they are comfortable with the credits. They can invest in 5 different or 5 to 6 different bonds in various lenders, right, to diversify issuer risk and other risks as well. So all put together, I think diversification for investors, whether they want to go through a PMS or an AIF or directly also, are to a large extent sorted out by the new reduction in face values of bonds, and the fact that platforms are offering bonds at 1 lakh or 2 lakh lots, or even if it's a public debt issue, even 50,000 rupee lots and other things.
Yes, absolutely, Arjun. I think what you said perfectly makes sense because as the face values have come down, and if you are a bond investor, you can pick and choose, also diversify because the lots are much smaller than what they were earlier, and plus you can pick and choose credits which you are comfortable with, and have a diversified portfolio which is under your control rather than basically being dependent on a third party manager, right? And I think INR bonds does that part very well, where the bonds can be sourced and also could be sold on the platform. That is also one important aspect, I believe, because that gives a lot of liquidity to the underlying portfolio, which also should be considered by the investors.
Yeah, and obviously wealth managers like you and teams like yours with you heading it will give comfort to the investors on their own diversification through very strong information, research, and the fact that you can give them the best prices that are available in the market as well, right?
Absolutely.
Yeah. There is one more aspect we have seen is a lot of ultra high net worth money have gone into the new high yield, I would say ultra high yield. If you look at and if you put it in a global perspective, junk bond funds, AIFs offering 15 to 20% kind of portfolio yields, right? And what do you make of these trends? These are all maybe 3 to 4 year lock-in funds, and largely investing in private credits, unlisted, but performing well. And investors do seem to have a lot of faith in this. Now, is there a cap to the total amount that can be raised in this because of the absorption capability of the industry? Or if they're absorbing too much, then they can manage. Is there a risk to investors? Or is the economy supporting the whole structures of these?
Yeah, so you are right, Arjun. I mean, what's happening is that investors are still chasing that post-tax returns that they were used to, right? So after having a 3 year investment in a mutual fund and that the indexation benefit, you would end up anywhere between a reasonable post-tax return. Now, if you want to, you have a habit of having those returns in your portfolio, then only way to do it is to move down the credit ladder and go towards bonds which yield in the 14 to 18% kind of a range, because if you are taxed at the highest bracket, then that's where you will end up being if you have a reasonably enough diversified portfolio. So that trend is there, and currently the economy has been supporting it, and it may support it for another 1.5 to 2 years. As you would know that the credit cycle currently is seeing favorable, but it may change depending on how the economy and the rates behave. But you cannot predict it for 4 to 5 years. So of course there is a risk, and I think investors should make a note of that when investing into such funds or papers directly. Um, Otherwise, it makes more sense to have a balanced and a diversified portfolio based on own risk-taking capability. I mean, there is a lot of risk which is involved, but of course the return is also significantly higher than you would get in the normal performing credit or the sovereigns or the AAA bonds.
Yeah, right. And we also seen now, while they have that 15 to 19% range that is going largely to the AIFs and no liquidity private credit market. You also have bonds that are coming out. Some of them good, some of them bad, some of them with visible positive uptrend and fundamentals, some of them unsure. And largely coming in a 3 year to 5, 6 year kind of maturity, right? So in this sense, what would be your advice to your own investors and to the investors listening or advisors who are uh, building portfolio for the clients listening to this podcast on their investment strategies if going forward for their portfolios?
So I would suggest that it's when if the view is that the interest rates are near its peak, it's better to lock in yields, and short term, of course, should be only used for the parking of liquidity. It's better to basically add duration in the portfolio, and the 3 to 6 year bucket makes perfect sense. Today, if I have to buy a 3 year, 4 year bond, which is a AAA or AAA NBFC, is available closer to the 8% handle. And if I assume that the interest rates would come down 1 year down the line, even by a 50 basis points, I am making around 9.5, 10% kind of a return via not taking any risk. So my suggestion is to, if you don't have a risk-taking appetite and you are chasing returns which are in the 8 to 10% range, AAA and sovereigns make perfect sense. And with the capability of the bond platforms and INR bonds also capable of sourcing government securities in smaller lots, I think that strategy makes perfect sense because it gives you liquidity as well as reasonable returns for the next expectation of reasonable returns for the next 1.5, 2 years. Performing credits, I would not suggest to invest into papers which are very risky, with in the 18% handle, because as you rightly said, they are totally, or there is an element of illiquidity. You may not be able to sell those, and you may buy and hold. You will have to buy and hold, and there could be a turn in the credit cycle in the next 2 to 3 years, which we don't know how it may pan out, and there could be, you may be stuck with such papers. So it's better to have a balanced approach in the portfolio. Take risk which your portfolio permits you to do. I don't recommend to entirely invest into one category. It's better to diversify and have balanced returns coming out of fixed income.
That's very sound. And platforms like INR bonds, we 100% are listed bonds, so which have traded in the secondary market. Government securities, GSECs, SDLs, treasury bills, these are all are part of offerings of platforms now. And investors should be able to invest in a mix of corporate bonds, government bonds, across ratings, across ticket sizes through platforms like ours. And obviously, more, investors would look to wealth managers like Chirag for the best advice possible on their portfolios. And very happy to note that INR bonds and LGT are working very closely together to support them on the liquidity for the bonds and transactions and as prices, etc. And they provide both the advice and the portfolios to investors. Anything else you want to add, Chirag? And been a very good session with you. Very good takeaways for investors. Would like to hear your conclusive comments.
Yeah, thank you, Arjun. I think it was a pleasure to be with you on this podcast and share my thoughts, and also, basically know about INR bonds and the availability of products across the credit spectrum, right from the sovereign to even bonds that are rated lower but listed, secured, etc., which becomes a very good diversification for the portfolio depending on what yield one is chasing. In conclusion, I would like to maintain that it's the time to invest and consider fixed income or bonds as a part of your portfolio, because the interest rates are near its peak or at its peak, according to me. Building a bond portfolio right now makes perfect sense. One should not wait for the peak to come, because then the you may miss out on the rates that are available right now. And in the next 1 to 2 years, we definitely would see that the interest rates would be coming down globally as well as in India, and hence your fixed income investments would give you better returns than except the of course the coupons or the interest that are received. There you would also be experiencing capital gains down the line.